Welcome to the Research Desk.
Glad to be here for this one. It's a big topic today.
It really is. I want to start by taking everyone back to 2022. Just, put yourself back in that headspace.
Oh man, the inflation shock.
Exactly. Inflation was just absolutely raging. It hit, what, 6.5%?
Yeah, CPI was practically off the charts compared to the last 40 years.
Right. And if you look at the traditional playbook, the literal finance textbooks that we all learned from, it said that was the perfect time to own gold to protect your wealth.
That was the golden rule.
Yeah.
Literally.
Yeah. And it also said that a standard 60-40 portfolio, 60% stocks, 40% bonds, would cushion the blow. So what actually happened?
Well, gold basically stayed flat. It did almost nothing.
Completely flat. And the traditional 60-40 portfolio, it was absolutely slaughtered.
Worst performance in decades.
Right. So today, we are speaking directly to you, the listener. We're treating you as chief strategists. You're sitting right here at the table with us.
And we are looking at the exact same volatile, highly unpredictable economic landscape you are.
Yeah, and we are not going to hedge our bets today. No sugarcoating the analysis. We're getting straight to the point.
Direct and authoritative.
Yeah.
That's the only way to handle this data.
Exactly. Because the mission of this deep dive is to unpack what is arguably the ultimate investment question of 2025.
The one everyone is secretly panicking about.
Right. And that question is this. Are we making a fatal error by using either old macroeconomic models or even these shiny new alternative data models as if the underlying economic regime hasn't completely and utterly changed?
That is the defining question of this entire cycle. Without a doubt.
Because things have changed, right, structurally.
Oh, completely. What we are really looking at here is a fundamental, I would say, violent shift in the tectonic plates of the global economy.
A violent shift. I like that phrasing.
Well, it's true. For decades, we operated in a very specific, highly forgiving environment. It was a disinflationary, rapidly globalizing world.
Everything was getting cheaper and more connected.
Exactly. And the playbooks were written entirely for that world. The valuation frameworks, the safe haven assumptions, the quantitative factor models.
All of them.
Yeah, they were all heavily calibrated to an environment that, frankly, essentially no longer exists.
So where are we standing now?
Now, we are standing in a world defined by persistent, sticky inflation, by severe geopolitical fracture.
Supply chains breaking apart.
Right. And by markets that are moving reflexively faster than they ever have before. We've transitioned from a regime of abundance and predictability
To what?
to a regime of absolute scarcity and weaponized information.
Wow. Okay, let's unpack this because the central conflict here, the dramatic tension that's really driving all the research we're going through today, is this vicious battle between two very different investment philosophies.
It's a bloodbath out there between the quants and the macro guys.
It really is. On one side, you have the aggressive advocates for these highly adaptive, alternative data-rich regime models.
The AI crowd.
Yeah, the data scientists. They are looking at satellite feeds and credit card scrapes, and they argue that the old ways are just hopelessly structurally too slow.
And they have a point, but
But on the other side, you have the defenders of durable, classical frameworks, and they are asking a truly terrifying question.
which is whether these ultra-fast models actually work out of sample.
Right. Do these new models truly outperform, or do they merely create this dangerous illusion of false precision right at the exact moment when investors desperately need reliability?
And the stakes could not be higher. If you get this wrong, we are not just talking about a minor forecasting error.
Like missing a GDP print by 0.1%.
Exactly. You miss a print, you underperform your benchmark for a month, you apologize to your clients, you move on. That's a normal error.
But this is different.
This is catastrophic capital misallocation. Think about what is actually at risk here. We're talking about whether you can still trust the fundamental valuation frameworks that price your entire equity book.
The actual math behind what a stock is worth.
Right. We're talking about whether your safe haven assumptions actually provide any mathematical safety when a shock hits.
Because if they don't...
If you apply a disinflationary playbook to a persistently inflationary world, the models won't just bend. They will break.
They just snap.
And they will take your entire portfolio down with them.
Yeah, if the old shortcuts break down, if, say, sovereign bonds suddenly don't hedge your equity risk cleanly anymore.
Which we saw in 2022.
Exactly. Or if the quantitative factor models that you just casually imported from Western markets completely misread the local dynamics in China and Hong Kong.
Which happens constantly, by the way.
Right. These aren't just small tactical missteps that you can just trade your way out of on a Tuesday. They are structural failures, the very foundation of your portfolio crack.
It's game over for that strategy.
But before we start taking sides in this dramatic tension between the old guard and the new algorithmic models, we need to establish the baseline.
We have to find the common ground.
Because what is really fascinating when you really dig through the research is that the strongest opposing views actually converge on three undeniable realities.
Yeah, both the bleeding-edge data scientists and the oldest school macroeconomists actually agree on these three things.
It's rare, but they agree. Let's walk through them methodically.
Sounds good.
So, reality number one. Traditional macro indicators are weakened, but they are not dead.
Right. The consensus across the board is that classical signals, things like the yield curve, purchasing managers' indexes, unemployment claims, consumer sentiment.
The stuff we've watched for 50 years.
Yeah, they still fundamentally matter.
Yeah.
They still describe the underlying physics of the economy.
So we aren't throwing the classical indicators out. I mean, we aren't just burning the old textbooks and handing the keys over to a neural network.
Absolutely not. You don't burn the textbook because the textbook still explains the laws of gravity.
Gravity still exists.
Right. A recession still propagates through credit contraction and demand destruction. The old indicators measure those physical forces perfectly.
There's always a but.
But you do have to acknowledge there's severe limitations in the current era. What has happened is that the tactical edge of these classical indicators has severely eroded.
How so? Walk me through the mechanics of that.
Think about how a PMI, a Purchasing Managers Index, is actually created.
Okay.
You are sending physical surveys or emails to supply chain managers. You're asking them, hey, are you buying more cardboard or copper this month than last month?
Right, it's a sentiment check on actual buyers.
Exactly. So they fill it out, they send it back, it gets aggregated by an agency, it gets smoothed out statistically, and then it gets published weeks later.
Weeks after the fact.
Weeks. And in faster, more digitized markets, by the time that traditional monthly or quarterly indicator actually prints on a Bloomberg terminal,
Yeah.
the market has already priced it in.
The algorithms have already traded it a million times over.
Right. These classical indicators just no longer suffice on their own to give you a first-mover advantage. They describe the terrain perfectly, but they don't give you the real-time radar you need to navigate it before the storm actually hits.
Which brings us to reality number two, which I think is fascinating. The complete redefinition of what a safe haven actually is.
This is crucial.
Because in the old world, the disinflationary world we grew up in safety was incredibly simple. You just bought bonds.
You bought bonds and you went to sleep.
Exactly. If stocks went down, bonds went up. It was a seesaw.
Right. But persistent inflation and geopolitical shocks mean that nominal safety is no longer real safety.
Let's pause there, because I want this distinction to be crystal clear for our listeners. When we say nominal, what are we actually talking about?
When we say nominal, we mean the face value of the money, literally what is printed on the paper.
Okay.
So if you hold a duration-heavy sovereign bond, let's say a 20-year U.S. Treasury, it might promise to pay you back your exact principal amount.
It promises I get my $1,000 back in 20 years.
Right. That is nominal safety. The government won't default. But it can utterly fail to protect your portfolio's actual purchasing power when inflation remains sticky.
Because that $1,000 won't buy the same amount of groceries.
Exactly. Cash is exactly the same way. Cash only works as a safe haven if real yields, meaning the yield you earn on that cash after subtracting inflation, are actually positive.
Let's do the math on that just to make sure the mechanism is obvious. Let's say you're earning 4% on your cash in a money market fund. You feel great, right?
You feel very safe.
But if inflation is running at 6%, your so-called safe haven is mathematically guaranteed to lose 2% of its purchasing power every single year.
You are slowly bleeding to death while feeling perfectly safe in your hospital bed.
God, that's a bleak way to put it, but it's true. You're losing money safely.
And that specific dynamic completely breaks the old, reliable 60-40 portfolio intuition.
Because the seesaw breaks.
Precisely. For decades, investors were trained to believe that stocks and bonds were inversely correlated. But the reality is that the 60-40 is dangerously unreliable today.
Why?
Because in a severe inflation shock, both stocks and bonds can and will fall at the exact same time.
We saw that in 2022. But mechanically, why does it happen?
Because the central bank has to aggressively raise interest rates to fight the inflation rate.
Right.
Well, higher rates crush bond prices mechanically. As yields go up, bond prices go down. That's just math.
Right, the bond side gets slaughtered.
And at the exact same time, those higher discount rates crush stock valuations. Future cash flows are worth less today, so
Yeah.
the old inverse correlation just breaks.
And suddenly your trusty diversifier, your bonds, becomes an accelerant to your equity losses.
Mhm.
You're losing on both sides of the book.
Exactly, which is a nightmare for portfolio construction.
Okay, reality number 3. Portability versus universality. This one specifically applies to factor models, right?
Yeah, quantitative factor investing, things like value, momentum, quality, low volatility.
Right. And the research states quite bluntly that developed market models don't just travel seamlessly across the globe.
They absolutely do not travel. You cannot just put them in a suitcase in New York and open them up in a new market like Shanghai.
You can't just take a quantitative factor model built on U.S. market data, which assumes a purely free market, profit-maximizing environment, and blindly apply it to China A shares.
Or the Hong Kong market.
Yeah.
No, the research is definitive on this. It's a massive mistake.
Why? What's so different about the water there?
In those markets, you have fundamentally different local market microstructure. You have heavy state influence. You have frequent policy intervention from the government.
And a totally different investor base, right?
Yes, massive, massive retail investor participation.
Let's dive into that retail aspect. How does the Chinese retail dynamic specifically break a Western quantitative factor, like, say, value or momentum?
It breaks it entirely through behavioral mechanics. Think about the U.S. In the U.S., institutional capital completely dominates daily trading volume.
The big mutual funds, the hedge funds, the algorithms.
Right. So factors like momentum or value tend to revert to the mean over predictable institutional timeframes because professionals are trading against professionals.
Okay, that makes sense.
But in the China A share market, a vast majority of the daily trading volume can be driven by retail investors. Individual people trading their own accounts.
Mom and pop traders.
Exactly.
Mm.
And retail flow is highly sentiment-driven. It often moves in massive, synchronized waves based on policy announcements or even just rumors on social media.
It's not based on deep dive cash flow fundamental analysis.
Not at all. So if a U.S. model sees a stock trading at a deep discount to its book value, it flags it as a value buy. Right? It assumes the market is rational and will eventually recognize its fundamental worth.
Yeah, that's standard of value investing.
But in a state-guided economy, that stock might be cheap for a very good reason. It might be cheap because the state has implicitly capped its profitability for social or political reasons.
Oh, wow. So the stock is permanently cheap by design.
Exactly. A value stock in a state-guided economy behaves very differently than a value stock in a purely free market system. If you ignore that local reality, your model isn't generating alpha. It's generating pure noise.
That is fascinating. Okay, now, to really ground this entire debate, because we've been talking high-level theory, we need to look at the 2 specific methodological data points that are driving the conversation across all these research sources.
Yeah, let's get into the hard numbers. These are the stats that both the bulls and the bears are just endlessly fighting over.
Right. So point A is this massive study on a deep learning-enhanced systemic risk model. And it showed a staggering 19.2% accuracy improvement over traditional models.
19.2%.
Yeah, I mean, when you hear a 19.2% improvement in financial modeling, it sounds like the absolute holy grail. It sounds like you've solved the market.
It does sound like magic.
Yeah.
But we have to be incredibly precise here because this is exactly where false precision creeps in and ruins portfolios.
Okay, precision. Give it to me.
That 19.2% accuracy improvement was specifically for modeling financial contagion.
Meaning what, exactly?
Meaning how stress spreads through a highly interconnected banking system. It was looking at counterparty risk, interbank lending rates, and how a default at Bank A mechanically cascades over to Bank B.
So it's basically modeling a domino effect in a very specific network.
Precisely. It was not, and I cannot stress this enough, it was not for broad economy-wide recession forecasting.
That is a vital distinction.
It's the difference between predicting that a highly connected financial network will panic, which happens in milliseconds, versus predicting that everyday consumers will stop buying washing machines in 6 months.
Right. Buying washing machines is a slow, messy human decision. Bank contagion is just math and margin calls.
Exactly.
Okay, so that's point A. Point B is the recurring claim from the alternative data camp. They state that proprietary alternative data-heavy models are consistently identifying economic downturns 3 to 6 months earlier than the traditional market consensus.
3 to 6 months is an eternity in finance.
It is. And they aren't just calling it early on paper. They claim they are translating that timing advantage into a 5 to 10% outperformance in defensive positioning.
That's a massive number. 5 to 10% alpha just from timing the defense correctly.
Right. So what is the consensus view from the research desk on those specific numbers? Are they real?
The consensus is that they are directionally plausible. The logic absolutely holds together. But, and this is a massive but that every chief strategist listening right now needs to hear, they are only valid if they can be rigorously proven at a sample and across entirely different economic regimes.
Meaning they have to work in an environment the model hasn't been trained on.
Exactly. It is incredibly easy for a smart data scientist to build a model today that perfectly predicts all the recessions of the past. It's called overfitting.
You just give it the answers to the test.
Right. It is an entirely different challenge to build a model that can successfully navigate a future it has never seen under conditions that haven't even existed yet.
Okay, so let's pivot to the strongest argument for tearing down the old systems entirely. Let's look at the bull case.
The regime-aware investing argument.
Yes, the argument that regime-aware investing has already fundamentally replaced static frameworks. The core of this argument is just a very blunt observation. Markets today process information significantly faster than the very indicators we still call leading.
And this comes down to the critical difference between strategic value and tactical value.
Break that down for me.
Okay, a traditional quarterly recession signal, like a GDP print or a deeply smoothed unemployment trend, might explain the historical timeline perfectly.
It tells you what happened.
Right. It might tell academic economists exactly when the recession started, retroactively. But that strategic historical value completely fails the actual portfolio manager who needs to allocate capital today.
Because they can't trade on yesterday's news.
Exactly. That manager needs tactical value. They need to act before the market reprices the assets.
Think about the shift from floor trading to electronic markets. I love this analogy from the research because it makes the mechanics of this shift so clear.
It's the perfect parallel.
Right. Because in the old days, you had guys literally screaming in pits, waving paper tickets, using hand signals to execute trades. It was physical.
Very loud, very slow.
Yeah. Then the order books digitized. Execution became instantaneous. Algorithms replaced the guys in the color jackets.
Right.
Now, when that transition happened, the underlying economics of supply and demand didn't actually change. A company's intrinsic value didn't magically change just because the stock was traded on a server instead of a wooden floor.
No, the math of the business was identical.
What changed was the speed of transmission, the speed of price discovery.
And that is the perfect way to understand what is happening to macroeconomic models right now. The underlying mechanics of a recession, credit tightening, demand falling, inventories building up, those forces are the exact same as they were in the 1970s. But the speed at which the market recognizes and prices in those mechanics has gone completely exponential.
So if you are a portfolio manager relying solely on a traditional indicator,
while the algorithmic market is instantly repricing supply chain stress or credit deterioration based on real-time data feeds,
yeah, what are you doing?
you are effectively trading the autopsy report.
Ouch.
It's true. You are reacting to the official cause of death long after the body has gone cold. By the time you get the official PMI data saying manufacturing is slowing down, the equities exposed to manufacturing have already dropped 15%.
You're just the last one to the exit.
Exactly.
So what are these new models actually looking at? If they aren't waiting for the quarterly GDP print or the monthly jobs report, what exactly is giving them this 3 to 6 month edge? How do they literally see the future?
The edge comes from the sheer volume and velocity of high-frequency signals they ingest.
Like what?
Well, we are talking about real-time credit card transaction data. Instead of waiting for a quarterly retail sales report from the government, these models scrape anonymized credit card panels daily.
Oh, wow.
Yeah, they measure consumer health across specific zip codes, specific income brackets, hour by hour.
So they know if people stopped buying lattes in Chicago yesterday.
Literally, yes. And we
Yeah.
are also talking about satellite tracking of shipping flows and port congestion.
Right. They don't wait for import-export data.
No, they literally look at high-res images of the number of container ships anchored off the port of Long Beach. They measure the shadows of the oil tanks to see how full they are.
That is wild.
They track retail foot traffic through mobile phone geolocation data. They want to see if people are actually walking into stores or just staying home.
And employment.
They scrape real-time labor postings on job boards to see if companies are quietly freezing hiring weeks before the official unemployment rate even ticks up.
Wait, if the market processes credit card data in milliseconds, How can a quarterly GDP print matter at all anymore? Isn't it practically ancient history by the time it comes out?
It is ancient history for pricing liquid assets, yes. You can't day trade off GDP.
Right.
But it still fundamentally matters for confirming the baseline.
Why?
Because the high-frequency data is incredibly noisy.
Give me an example of that noise.
Okay, let's say there's a massive blizzard on the East Coast. It might completely crush mobile foot traffic and credit card spending for a solid week.
Nobody's going to the mall.
Right. And a purely algorithmic model might interpret that sudden drop as a massive, sudden consumer recession.
It sees a crash in spending and panics.
Exactly. So the traditional slower indicators act as the grounding mechanism. They tell you the underlying trend. But the edge, the alpha, is entirely in high-frequency space.
So the edge isn't magic. It isn't some metaphysical crystal ball.
No, it is pure timeliness. Being right, but being right first.
Let's ground ourselves in those numbers again, because they are staggering when you think about compound returns. The bulls claim that by flagging macro deterioration 3 to 6 months earlier than the traditional consensus, you completely change your risk-adjusted returns.
You change the entire game.
That 3 to 6 month head start is exactly what yields that 5 to 10% defensive outperformance we talked about. Because if you know the storm is coming a full fiscal quarter before everyone else, it changes everything.
It changes your duration choices and fixed income. It changes your position sizing. It completely changes your liquidity posture.
And this brings us to a really critical point about valuation conditionality, because a lot of fundamental investors still rely heavily on traditional discounted cash flow models, or DCFs, to value equities.
Yeah, the classic Warren Buffett, Ben Graham style modeling.
Right. But a DCF model is entirely cosmetic if the macroeconomic assumptions built into it are wrong.
Let's explain the mechanics of that because it's vital. In a DCF, you project how much cash a company will make in the future.
Right. You guess their profits for the next 10 years.
And then you discount it back to today's value using a specific interest rate.
The discount rate.
Precisely. The discount rate is the gravity of the valuation. Think about a high-growth technology stock trading at a 30x price-to-earnings multiple.
Okay, 30 times earnings. Pretty expensive.
Well, at 30x PE, in a benign, low-inflation, high-growth regime where interest rates are near zero, that valuation might look perfectly reasonable.
Because cash is cheap.
Exactly. The math works because future cash is cheap to wait for. But take that exact same company with that exact same 30x PE and drop it into an inflationary, recessionary regime.
Where capital is suddenly expensive.
Right, where interest rates are at 5% and top-line growth is stalling, suddenly that 30x valuation is completely absurd.
But the company hasn't even reported bad earnings yet.
That's the point. The cash flow hasn't even changed yet, but the regime changed the discount rate and the stock price inevitably collapses.
The sources provide some mandatory historical cases to prove this exact point. Let's look at the 2008 financial crisis.
Oh, perfect example.
Investors who were clinging to static, classical models learned the hard way that tiny, seemingly marginal changes in macroeconomic assumptions vaporized equity value exponentially faster than the trailing multiples ever implied.
If you looked at bank stocks in early 2008, their price-to-earnings ratios looked incredibly cheap based on their trailing earnings.
They look like deep value plays.
Right. But a slight shift in housing elasticity and a massive spike in overnight funding costs completely broke the regime.
And the traditional models just sat there and watched it happen. They kept insisting the stocks were cheap all the way down to zero.
Yep. And the 2020 COVID shock was an even more brutal demonstration of this.
Because it happened so fast.
It was a scenario where macroeconomic discontinuities vastly outran anything the standard models were programmed to understand. I mean, the traditional indicators couldn't process a global, synchronized economic shutdown in real time.
Because there's no historical baseline in a traditional model for every business in the world legally closes tomorrow.
Exactly. The model literally doesn't have a category for that. But the alternative data models, they could see the immediate collapse in mobility data, restaurant bookings, flight tracking.
They caught the reality of the shock in a matter of days.
Well, the traditional models were waiting for the next month's data release to confirm what was already obvious to anyone looking out a window.
Okay, so if the regime has changed, the bull view on safe havens has to change with it. What is the new adaptive hierarchy for defending a portfolio?
The adaptive hierarchy completely restructures the old 60-40 playbook. At the top of the hierarchy now, you have short-duration government paper.
So, treasury bills.
Yes. You avoid long duration because of that sticky inflation risk we discussed earlier. Next down the list, you have cash, but strictly conditionally.
Only when real yields are attractive.
Exactly. Then you have gold.
Yeah.
And finally, you have a very specific focus on real assets that have explicit inflation linkage.
Let's walk the listener through the explicit math on that real asset point, specifically using the REIT example from the research desk. I think this really clarifies things.
Let's do it.
Imagine you have a real estate investment trust, a REIT. Let's say it owns, I don't know, logistics warehouses.
Great asset class right now.
Right. And it is currently yielding 5%. But crucially, it has contractual 3% annual rent growth built directly into its leases with its tenants.
So the income is legally required to go up 3% every year.
Exactly. And it is trading at a valuation of 15x price to funds from operations, or PFFO.
Let's clarify PFFO for those who don't trade real estate daily.
Go ahead.
PFFO is essentially how we measure the actual cash a real estate company generates from its physical properties, adding back non-cash depreciation. It's the real cash yield.
Okay, so we have this REIT, yielding 5%, growing at 3%, trading at 15x PFFO. Now imagine an economic environment where inflation is running hot at 5%.
Painful environment.
Right, but that specific REIT acts as a structural pass-through. The rising rents mechanically offset the inflation.
From a total return perspective, that setup vastly outperforms holding a static nominal bond that is just yielding a flat 4%, while 5% inflation eats away its purchasing power.
It's about finding assets that mechanically adjust to the regime, rather than assets that just promise a fixed nominal return.
And this brings us to perhaps the most controversial part of the bull case.
Oh, here we go.
The crypto extension.
Right. What's fascinating here is that the most serious proponents of digital assets in these institutional frameworks, they're not claiming that crypto has completely replaced gold.
No, not at all. That is a straw man argument used by the bears to just dismiss the asset class entirely.
Right. They aren't saying empty out the physical gold vault, sell all the bullion, and buy a hard drive.
Exactly. What they're actually recommending is a highly specific, mathematically sized allocation based on regime probability.
So what are the numbers?
The consensus bull view in the research suggests a 2 to 3% allocation as a satellite hedge against fiat debasement.
Just 2 to 3%.
But the boldest claim in the research pushes that up to a 10% allocation.
10% is huge for an institutional portfolio.
It is. They recommend a 10% strategic basket consisting of Bitcoin, Ethereum, and select decentralized finance, or DeFi, tokens. And they specify building it systematically over a 12 to 24-month period to smooth out the volatility.
And what's the fundamental thesis for taking that kind of risk?
The thesis is that in a world of geopolitical fracture, where foreign reserves of entire nations can be frozen overnight and persistent inflation constantly erodes fiat currency, you need a non-sovereign bearer asset.
Something that exists completely outside the traditional fiat banking architecture.
Exactly.
Here's where it gets really interesting, because you hear all that. The speed of the alternative data, the 3 to 6 month head start, the 19.2% accuracy improvements, the dynamic inflation hedges, the crypto optionality, and it sounds incredibly compelling.
It sounds like the future.
You almost feel foolish for ever looking at a traditional GDP print again, but we need to slam the brakes.
Hard.
We need to look at the bear case. Because there is a very vocal contingent of macro skeptics who argue that these new models are undeniably smarter, but they are still not proven enough.
Right. The fundamental question is, are we replacing durable reliability with untested false precision?
As the sources note, obsolete doesn't just mean less exciting. Sometimes boring is what keeps you alive.
And the bears bring a very heavy arsenal to this debate. They are not just stubborn Luddites holding on to paper charts.
Not at all. And their ultimate weapon, the one that really stops the AI quants in their tracks, is the defense of the classical yield curve.
Specifically, the spread between the 10-year Treasury bond and the 3-month Treasury bill.
Wait, for the listener who isn't staring at bond yields all day, what does that actually mean mechanically? Why does a 3-month bill yielding more than a 10-year bond literally break the economy?
It's all about the mechanics of banking.
Okay.
Banks fundamentally make their money by borrowing short-term and lending long-term. They pay you a short-term interest rate on your savings account.
Which is usually pretty low.
Right. And then they charge a higher long-term interest rate on a 30-year mortgage they give to someone else. The difference between those two rates is their profit margin.
The net interest margin.
Exactly. So when the yield curve inverts, meaning the short-term 3-month yield is actually higher than the long-term 10-year yield, that banking model completely breaks.
Because they are paying out more for deposits than they are making on new loans.
Yes. It literally becomes unprofitable for banks to lend money. So what do?
They stop lending.
They stop lending. Credit freezes. Businesses can't get loans to expand or make payroll. Consumers can't get mortgages. Demand collapses, and a recession inevitably follows.
The yield curve isn't just a statistical predictor. It is the actual physical mechanism that causes the economic contraction.
Exactly. And the history here is undeniable. This specific spread, the 10-year minus the 3-month, has inverted prior to every single U.S. recession since 1956.
Since 1956, think about the sheer scale of that track record. It has survived entirely different Federal Reserve regimes.
It survived the abandonment of the gold standard in 1971.
It survived the dot-com bubble, the housing crisis, the zero interest rate era of the 2010s.
And across all those decades, across all those crazy regimes, it has had only one major false positive.
Which was when?
Which occurred in 1966, and honestly, even that was followed by a significant economic slowdown, just not an official recession.
So when the AI models say the yield curve is too slow, the bears just look at them and say, show me an AI model with a flawless track record going back to 1956.
Right. It is not nostalgia. It is mathematical fact.
Exactly. And the skeptics aggressively critique the claims made by the artificial intelligence and machine learning camps. They point right back to that 19.2% accuracy improvement we talked about earlier.
The bears remind us, forcefully, that this improvement was for modeling financial contagion, which is a highly data-rich environment that moves incredibly fast.
Tons of data points every second.
Right. But predicting a broad structural macroeconomic recession is an entirely different beast. Macro is what data scientists call a low-signal, low-frequency domain.
Because recessions just don't happen that often.
Exactly. There simply aren't that many recessions in modern history to train an AI model on. You have maybe a dozen real business cycles to study in the post-war era.
That's nothing for an AI.
It's nothing. An AI trained on billions of alt data points, but trying to predict an event with only 12 actual historical outcomes is practically begging to be overfit.
Which raises an important question, and history provides a really stark warning about the danger of overfitting. If you feed an AI a small data set with thousands of variables, it will inevitably find a pattern that perfectly predicts the past, but completely fails in the future.
We saw this exactly with the failure of long-term capital management in 1998.
Let's dive into LTCM, because it is the ultimate cautionary tale of model risk.
LTCM was a hedge fund that literally had Nobel laureates on staff. Guys like Myron Scholes and Robert Merton. They were the smartest guys in the room.
They invented the math everyone else used.
Yes. They had the most elegant, mathematically perfect convergence models in the world. They traded on historical spreads between different types of bonds, assuming that anomalies would eventually revert to the historical mean.
Because they always had before.
Right. But it was a monument to model risk. Their models were massively overfit to a specific historical regime of rational liquid markets.
And they levered up, right?
Heavily. They were leveraged 25 to 1 based on the assumption that certain assets would never, ever correlate.
And then what happened?
Well, the Asian financial crisis hit, and then the Russian government unexpectedly defaulted on its domestic debt in 1998. Panic ensued, and the correlations their models relied upon completely broke.
Everything went down together.
Everything. We saw the exact same breakdown of historical correlations during the 2008 crisis, where complex mortgage models assumed nationwide housing prices couldn't possibly fall simultaneously.
Because historically they hadn't.
Right. Complex models create a false sense of security right up until the exact moment they explode.
And there's a massive human element here that models just cannot process. A machine learning model lacks causal insight.
It doesn't know why things happen.
Yeah, right. It looks at millions of numbers, but it doesn't understand why the numbers are moving. A data model cannot parse the geopolitical nuances of a naval blockade in the Red Sea.
It cannot predict an election shock and the subsequent radical policy shift.
It cannot factor in the sudden, arbitrary imposition of international sanctions. As we said earlier, the 2020 downturn wasn't a mathematical extrapolation of prior economic data.
No, it was a sudden public health shock.
The bears argue that these heavy data models are essentially brittle, autonomous truth machines. They work perfectly until they encounter something they have literally never seen before.
And the bears don't stop there. They systematically dismantle the safe haven revisionism, too, particularly the argument that crypto is superior to gold in the modern regime.
Let's look at the hard numbers on that, because the data here is definitive and honestly ruthless.
Let's look at how gold and the S&P 500 reacted to inflation over a critical 3-year period.
Okay.
In 2021, U.S. CPI inflation started running hot, hitting plus 7.0%.
Really hot.
Now, according to the old playbook, gold should have skyrocketed.
It should have been a rocket ship.
Instead, gold actually went down 3.6% for the year, while the S&P 500 surged up 26.9%.
So gold completely failed as an immediate inflation hedge right out of the gate.
Correct. But look at 2022. The regime shifts. CPI is still extremely high at plus 6.5%. The Fed starts hiking rates aggressively.
Panic sets in.
Right. And what does gold do? Gold stays relatively flat, acting as a true store of value. It was down just 0.3%, but the S&P 500 crashes, ending the year down 19.4%.
Wow.
Then, in 2023, inflation starts cooling down. CPI drops to plus 3.1%. What does gold do? It shoots up 13.1%, while the S&P 500 recovers and goes up 24.2%.
So the lesson here isn't that gold is a perfect mechanical hedge that ticks up every single time inflation does.
No, it's a conditional hedge that operates on its own complex cycles of real rates, dollar strength, and global central bank buying sentiment.
But the decisive comparison, the one that really strikes at the heart of the crypto as safe haven argument, happened during the Q1 2022 Russia-Ukraine shock. This was a classic, severe geopolitical crisis, the outbreak of a major land war in Europe. The exact scenario a non-sovereign safe haven is supposed to protect you from.
The ultimate test case for digital gold.
Right. And during that first quarter, gold rose 6.9%, and its maximum drawdown during that incredibly volatile period was only negative 4.5%. It did its job. It protected capital.
And how did Bitcoin perform in that exact same geopolitical window?
It wasn't pretty.
Bitcoin fell 1.8% overall, but more importantly, it suffered a massive maximum drawdown of negative 25.7%.
You just cannot ignore that number. A safe haven asset that loses a quarter of its value, down 25.7% in the very first quarter of a global crisis, has fundamentally not earned the title of a safe haven.
It behaved exactly like a high-beta technology stock, not digital gold. When investors panicked, they dumped it for cash.
Because they needed liquidity.
Exactly. Beyond the asset classes, there is also a harsh operational reality that the skeptics point out regarding alternative data itself.
The actual cost of doing this stuff.
Setting up satellite feeds, scraping millions of credit card transactions, analyzing port logistics, that data is incredibly expensive to acquire.
And it's notoriously messy. Think about credit card data alone. You have to adjust for inflation, for changes in market share between Visa and MasterCard, for the fact that wealthier consumers use certain cards more.
It requires massive, highly paid teams of data scientists just to clean the signal from the noise.
And critically, it lacks a robust backtesting history across multiple different economic cycles. You might have great alt data for the last 10 years, but how did that exact data set behave during the 1970s inflation shock?
You don't know because the data literally didn't exist.
Whereas traditional indicators, the yield curve, the unemployment rate, are practically free to access, their methodology is entirely transparent, and their history goes back decades.
Exactly. And the skeptics also apply this rigorous operational reality to the idea of localizing factor models in China and Hong Kong.
We touched on this earlier, but it really bears repeating.
It's not just a nice-to-have to adjust your Western quantitative models. If you export a static Western framework into the Chinese market without explicitly programming the model to account for state intervention and local retail momentum,
you are generating dangerous false confidence. The models will confidently tell you to allocate massive capital based on signals that mean something completely different in that regulatory environment.
Okay, before we move forward into how we actually allocate capital based on all of this, let's pause and make sure we have the right mental models.
We are throwing around a lot of very heavy concepts today.
Regimes, factor portability, alternative data ingestion, yield curve mechanics. We want to make sure you have ironclad frameworks for what we are discussing.
And the research desk provided some phenomenal analogies to really lock these concepts in.
The most foundational analogy is the barometer versus the satellite system. This perfectly encapsulates the entire debate between classical models and alternative data.
I love this one. Right. Traditional indicators, the yield curve, PMIs, unemployment claims, they are the barometer hanging on your back porch. They are incredibly reliable. They tell you about the local atmospheric pressure, and the underlying technology has worked for centuries.
But alternative data is a real-time, global satellite weather network. The argument isn't that the barometer is broken. The argument is about breadth, speed, and resolution. The satellite network sees the hurricane forming over the ocean days before the barometer on your porch ever starts dropping.
I love that. And for the safe haven debate, the mandatory metaphor is the Bangavault.
This one is sobering.
Think of traditional sovereign bonds and physical gold as a classic heavy steel bank vault. You look at it and it looks incredibly solid. It protected your wealth perfectly for the last 40 years.
But the regime has changed.
Right. The vault now has a vulnerability, a flaw in the locking mechanism that the original blueprint never contemplated.
And that vulnerability is persistent inflation eroding the nominal bonds and the geopolitical weaponization of central bank reserves.
The vault is still heavy, but it might not protect what is inside the way it used to if the thief attacks that specific new vulnerability.
If we connect this to the bigger picture, we can look at the film noir detective versus the cybercrime hacker analogy.
This perfectly explains the human element. The traditional macro model is the grizzled film noir detective. He relies on gut instinct, shoe leather, classic clues, and historical precedent.
In his physical world, he is brilliant.
But drop him into a modern cybercrime thriller, and he is completely outmatched by the hacker's environment. The rules of the game have digitized. The crimes happen at the speed of light.
Then there is the static black and white photo versus high-definition video.
Yeah, traditional macro prints like the monthly jobs report or the quarterly GDP, that is a static black and white photograph of the economy taken weeks ago. It captures a moment in time perfectly.
But high-frequency alternative data is a continuous high-definition video feed. You can see the motion, the momentum, the subtle shifts in real time. You aren't guessing what happened between the frames.
What about predicting a flash flood from a single raindrop?
This analogy critiques the danger of false precision and the over-reliance on single macro variables. You can't look at one traditional indicator, like a slight, isolated dip in consumer confidence, a single raindrop, and accurately predict a massive systemic flash flood in a highly complex, interconnected global economy.
You need the whole radar picture to separate a rain shower from a flood.
And finally, hardware versus software in the context of operational resilience.
Supply chains, physical infrastructure, logistics routes, the actual ships and ports. That is the hardware of the global economy.
But the adaptive people, the management teams navigating these regime shifts, the dynamic models we were discussing, that is the software. In a changing regime, you can have the best hardware in the world, but if your software is running an outdated operating system, the machine crashes.
Okay, so we have the bull case for the satellite network models, the bear case for the reliable porch barometer, and the mental models to truly understand them. But now we hit the blind spot.
The wild card.
This is the trapdoor that both the bulls and the bears are completely missing in their intense debate over who has the better data. So what does this all mean if we assume, just for a moment, that you perfectly predict the macroeconomic data? Let's say your model is flawless. Does that mean you win?
This is the upstream trap, and it is a harsh truth for anyone working in this industry.
Lay it out.
Better prediction does not automatically produce better decisions.
Wait, say that again, because that goes against everything we are taught.
Having a superior forecast does not guarantee you will make money. The entire debate we just went through focuses entirely on prediction, but prediction is strictly upstream, meaning portfolio construction, actually figuring out what to buy, exactly how much of it to buy, and precisely when to sell it is the inherently difficult part of the job.
The market timing disconnect is brutal. Let's say your cutting-edge AI model looks at the satellite data and perfectly predicts that the unemployment data is going to worsen dramatically in exactly 3 months.
You're right on the money.
Right, so you get defensive, you sell your equities and buy cash. But what often happens...
Markets are forward-looking mechanisms.
Yes. The equity market often bottoms out and starts a massive rally before the macroeconomic data actually improves.
Think about March 2009. The stock market hit rock bottom and began a historic bull run while unemployment continued to rise for months afterward. If you wait for the data to confirm your model, you miss the bottom and you underperform the benchmark.
Exactly. Or look at the gold example we discussed earlier. You might buy gold to perfectly hedge a specific geopolitical risk, but then find it fails you in a short-term inflation window because real rates spiked unexpectedly driven by a hawkish central bank.
You predicted the inflation, but you missed the central bank reaction function.
Or you might deploy a perfectly calculated factor strategy in China based on immaculate high-frequency data, and then a sudden, entirely unpredictable policy change from the state ruins the entire thesis overnight.
The signal was right. The real-world outcome was still a painful loss.
But wait, If the new models are too brittle and the old models are too slow, and even perfect prediction doesn't guarantee success, are we just paralyzed? How does a portfolio manager actually survive this?
This is where we resolve the core dramatic tension of this deep dive. Because after analyzing all this research, the conclusion is incredibly clear. The entire old versus new framing is a false dichotomy.
It is fundamentally flawed.
It is a false debate.
Yeah.
The research points to a synthesis called the regime adaptation doctrine.
Okay, the regime adaptation doctrine, what is that?
Traditional indicators encode decades of hard-won structural knowledge. As we established, recessions still propagate through the economy via credit tightening and demand destruction.
The classical models understand the physics of a downturn.
Right. New alternative data models, on the other hand, are strictly tactical. They detect the deterioration early and allow you to adapt your positioning before the herd moves.
You need the classical framework for the map to know what regime you were in, and you need the alternative data for the real-time GPS to navigate the immediate obstacles.
But the real danger, and this is the explicit warning label on the entire synthesis, isn't just making a mathematical error. The true risk is false precision.
A complex machine learning model that cannot survive a regime shift, or worse, a black box model that cannot explain why it is telling you to sell, is infinitely worse than a simple, outdated framework.
If you don't know why a model works, you won't know when it breaks.
If we connect this to the bigger picture, it means we need to start asking the wrong questions.
We need to stop asking broad, sweeping questions like, is the yield curve obsolete? And start asking, under what specific conditions, in what specific inflation regime, does the yield curve provide the best signal?
We need to stop asking, is gold a safe haven? And demand more precision. Against which specific shock inflation, currency debasement, or geopolitical conflict are we using gold to hedge today?
Right. It's about conditional logic.
So we've broken down the theory, we've synthesized the opposing views, we've established the mental models. Now it is time to translate this entire debate into pure, unhedged allocation strategy.
This is where the rubber meets the road.
What does this actually mean for your portfolio? We are going to walk through every single portfolio recommendation straight from the research desk, step by step, with the exact numbers and percentages. We are not holding anything back.
Let's get highly tactical. Recommendation 1. Anchor on a hybrid recession dashboard. Do not abandon the classics.
You must continuously monitor the 10-year minus 3-month Treasury spread, the PMIs, and traditional data, but overlay them with high-frequency inputs.
Here is the specific action trigger from the desk. If you see the 10-year minus 3-month spread invert by more than 100 basis points, and it stays inverted at that depth for 3 consecutive months, you take action.
100 basis points for 3 months. That's a deep, sustained inversion.
Yes. You immediately add 5% to your defensive allocations. That is a structural warning sign that supersedes any short-term data noise.
Recommendation 2. Favor short duration over long duration. In a regime where inflation can spike unpredictably and geopolitical shocks are frequent, holding long-duration fixed income is playing with fire.
The action here is highly specific. Overweight your short-duration fixed income by 7%. And increase your cash position by 3% over the next 12 months.
And for implementation, the research specifies using vehicles like the iShares 1-3 Treasury Bond ETF, ticker symbol SHY, or the Vanguard Short-Term Treasury ETF, ticker symbol VGSH.
You establish this posture, you take the yield, and you hold it firmly until your leading indicators show sustained improvement for a minimum of 3 consecutive months. You do not try to front-run the recovery on a single positive data print.
A 7% overweight to short duration is a massive, aggressive tilt. Why 7% specifically?
Because 7% is large enough to materially protect the portfolio's overall volatility in a rate shock scenario without completely abandoning the potential equity upside if the regime holds steady. It is a calculated risk budget.
Recommendation 3. Redefine your safe haven exposure. You still need defense, but it has to be conditional.
The action. Maintain a 10 to 15% strategic allocation to traditional defensives. That means gold and high-quality sovereign bonds. But you pair that with a 5% tactical TIPS overlay. TIPS as being Treasury inflation-protected securities.
The rules for managing the safe haven bucket are strict. If real interest rates turn consistently positive for 2 consecutive quarters, you must reassess your TIPS allocation because their relative value proposition weakens compared to nominal bonds.
Conversely, if global real rates fall below -2% for more than 2 quarters, you must reassess your gold position for overvaluation risk, as historical data shows gold often prices in too much fear at that extreme. You have to actively manage the safe haven based on real rates.
Recommendation 4. Use inflation-linked real assets. This goes back to our REIT example earlier.
The action here is to allocate 7% of the portfolio specifically to inflation-sensitive real assets. Think global infrastructure, toll roads, and very select U.S. REITs that have escalators built into their contracts.
Well, let's remind the listener of the explicit math we discussed earlier, because it is the entire justification for this 7% allocation.
If you hold a REIT yielding 5% today, with 3% contractual annual rent growth, and it is trading at a reasonable 15x price to FFO, that asset is fundamentally engineered to pass through inflation.
It will categorically outperform a static nominal bond yielding 4% in an environment where inflation is running at 5%. You are buying explicit cash flow pass-through.
Recommendation 5. Treat crypto strictly as a satellite. We touched on this during the bull case, but here is the final definitive ruling from the research desk.
The action. Strictly limit your exposure to 2 to 3% in liquid, large-cap crypto. The explicit tickers cited are Bitcoin, BTC, and Ethereum, ETH.
And I want to forcefully reject the bolder claims out there suggesting a 10% strategic allocation to crypto. The data absolutely does not support that level of risk for a safe haven asset.
We go back to the mathematical proof. The severe negative 25.7% drawdown that Bitcoin suffered in Q1 2022 during a major geopolitical shock.
That kind of correlation to risk assets entirely disqualifies it from being a core defensive pillar. It remains a 2 to 3% satellite option for monetary regime optionality, nothing more.
Recommendation 6. Overweight operational resilience. This isn't just about financial instruments, it's about investing in the physical rewiring of the global economy.
The action. Add a 7% allocation, phased in over a 3 to 5 year time horizon, focusing on industrial infrastructure, warehousing, automation, and reshoring plays.
These companies act as massive balance sheet hedges against the ongoing fragmentation of global supply chains and the transition away from a purely globalized world.
And finally, recommendation 7, localized factor investing in China and Hong Kong. We established earlier exactly why Western models don't travel blindly due to retail momentum and state intervention.
The action. You must require a bespoke, highly localized implementation layer before you allocate any active factor risk in Chinese A-shares or Hong Kong equities.
Do not let your quantitative managers import a New York playbook into Beijing or Hong Kong. It will systematically fail.
We've covered an immense amount of ground today, navigating between the deep history of classical indicators like the 1956 yield curve track record and the bleeding edge of alternative data scraping.
But if we recap the journey, the core narrative is clear. Traditional financial wisdom isn't useless. It hasn't been rendered completely obsolete.
But it is fundamentally incomplete. Faster, hyper-digitized markets demand new foresight.
Your safe havens are now strictly conditional. There's no more set it and forget it defense, not even with a steel bank vault.
And perhaps most importantly, the winning framework in 2025 is brutally, unflinchingly honest about the massive gap between building a model that perfectly predicts a downturn and actually executing a portfolio strategy that makes money from it.
Which brings us to the final definitive takeaway from all the sources we've unpacked today.
I want you to hear this exactly as it was written on the research desk because it is the skeleton key for everything we've discussed.
The real edge is not knowing the future first. It is knowing which framework to trust before the regime changes.
Think about that. The real edge isn't about having the fastest data. It's about knowing which data matters in the world you are actually standing in.
Because the regime dictates the rules.
Exactly. And I want to leave you with a final thought to mull over, something to take beyond just your financial portfolio. Consider the safe havens in your own career or in your own business.
That's a great point.
Are you relying on a classic bank vault of skills or business models? Does your strategy have a new vulnerability that the old blueprints never contemplated?
It's worth figuring out.
Because just like in macroeconomics, it might be time to figure out what regime your industry is actually in before the market reprices it for you.
Cool.
This is the research desk officially signing off.